Most investors don't struggle because they are lazy or they are not smart. They struggle because they are doing too much with too little clarity and too little patience. I'm going to share with you the one change that I'm making in 2026 that I think is going to change my returns. If you ever felt overwhelmed, like you were lost and unsure in the market, this video is for you. Here is what you are going to get from watching this video. You are going to learn about the biggest mistakes that I have made early on and the mindset shift that I'm going to be implementing this year, and how I think about cash risk and patience. Things that I think are also very important if you want to be a successful investor and trader. And the single framework that I actually follow, this is an honest, candid, practical conversation that is based on experience, not just theory. Quick disclaimer before we go any further. This video is for educational purposes and it is not meant for personal financial advice. So let's start off by why most investors and traders struggle. From what I have observed and my own personal experience, most investors struggle for a few reasons, among many other reasons, of course. They trade too often, they invest in businesses that they don't understand, and they chase excitement instead of following a disciplined approach, and they underestimate the power of patience. Many people start investing by asking, what stock is going up? I write for this Zimbabwean newspaper, and I mostly cover the US and Canadian stock markets and to an extent the global markets. And what I have noticed is that most people, they ask me, what stock should I buy? Which stock do you think is going to go up? In my view, I think the best approach is to ask myself, what businesses do I actually understand that I want to own? Most of the stocks that I own is because I use the products, I've experienced their services, and in the process, I then do the deep dive into their financials, like I've explained in other videos. I understand who is the management and other things that I consider to be important, like what product or service that they are providing and how I see that tying up into the bigger ecosystem of the global market. So my own shift that I think is pivotal in my trading and investing, like I indicated, is that I'm going to be trading less often. And in the past, I used to buy options. In this case, I want to be selling more options, selling cash secured puts for the stocks that I otherwise want to own. And I don't want to be reacting to each and every news that's going to cause short-term movement of price. Prices, of course, they go up and down. I tried to think I could predict the direction of the market confidently, and what I learned over time is that more activity didn't mean necessarily better results. It often meant lots of stress. Is my forecasting right? I'm not saying forecasting is bad, but I'm just saying what I've learned. So in 26, I'm going to be deliberate. I'm doing fewer trades by design. Not because I'm less serious, not because I'm less disciplined. So the one change that I want to emphasize is that research first, act later. I want to deepen my research and have a list of stocks that I want to be considering to trade or invest. So that's my core focus, to be building a watch list. Right now I have a decent list, and if you want to learn more about this, I coach clients and I am very happy to share with them that list. And of course, if you want to learn more, book on www.streetwiseeconomics.com so that you can have access to that. I also emphasize that one thing that I have learned is that building a watch list is very important, because sometimes you can have stock on the watch list for years, but if you are just patient, there might be opportunities. Stock misses earnings, or there's something that happens within the business, or the whole stock market drops for whatever reason, There are many reasons. So having the watch list is an advantage, because when that happens, then it's very much easier to act quickly with confidence. Because why people lose money is if you just jump in without understanding the business. If it drops further, then you may not have the confidence and panic and sell. So that's something that is important. Now, another important is some investors and even traders, they confuse investing and trading. Investing and trading is not the same. There are differences and similarities, of course, but investing is about owning businesses, and I'm looking at the long term, but trading is about managing risk and probability over a short period of time. So when I invest, I'm investing like an owner, and when I trade, I'm trading like a risk manager. It has to be a stock that I would be comfortable owning. In other words, it has to pass my framework checklist. That is, free cash flows, they should be growing and they should be positive, and I should see an increasing or improving cash and cash equivalence position, and low or manageable long-term debt, and quality management, and also things like a competitive advantage or what we call moat. In other words, businesses that can be, like if you look at NVIDIA, for example, they have 80% of the market share. So that means it's very easy to increase prices, all things constant, without necessarily losing the market. But the idea is that by the time other businesses try to catch up from 80%, maybe even if they take another market share, still my money would have been compounding. So by the time it loses the moat, if I get in at the right price, I will be exiting that investment. Now, why I shifted from buying options to selling options is another reason I wanted to share with you guys. I noticed that 90% of the time when I bought naked options, cash, calls, and puts, especially short-dated calls or puts, I would lose money. But when I was doing cash secured puts, in other words, selling options, I was making more money, free cash flows, and buying the stocks cheaper, because when I do cash secured puts, I want to go below the current price, especially after the stock has really gone down. So I'm buying this for a discount. Why? Because options, as an option seller, the decay works in my favor, and as an options buyer, decay works against me. Because each time you hold an option contract, let's say you buy an option contract, there is what is called decay, theta. So what that means, it's losing value in addition to maybe if the trade is going against you. So I like cash secured puts. It helps me in my cash flows. I get to grow my account and reinvest and support my lifestyle. So I intentionally now avoid naked options. The risk profile no longer fits my framework. Now moving on to patience, cash, and fear. Another mistake most investors make is staying fully invested all the time. Cash is not wasted opportunity, it's an optionality, because I like to keep some cash at least 20% available and monitor sentiment, including greed and fear indicators, and I wait. When there's a lot of fear in the market, that's where I want to be deploying, and there's uncertainty. Cash secured puts, right? And I want to be buying at that time. When there's a lot of greed, when the S&P is hitting all-time high, I want to be having more cash relative to my equity position. So that's something that I learned from Warren Buffett and also the late Charlie Munger, to say owning wonderful businesses at a discount during uncertain time is a sure way of increasing the odds of success in your investing or trading strategy. Now, another important thing is I want to stay informed about the macro issues, but rather not reactive. Geopolitics matter, including developments around the world. So I like to check it, Bloomberg, CNBC, what's going on, but I then do my own analysis, because not everything that I see there is relevant. So I want to stay aware and not chase headlines, but just to be aware. So for beginners who want to invest and trade, make sure you subscribe so that you can also learn from my experience here, but also book one-on-one coaching. My channel, my website, www.streetwiseeconomics. I can walk you through, of course, for a paid engagement because of my time, and also I use some paid resources. So that's very important that you start with a plan, educate yourself, and of course you can read books and also follow other helpful resources. So that's very important. Now, as I wrap up, many people ask me, how do I start investing? My honest answer is build an emergent fund, have a savings plan, invest in education, then invest in the market. But of course, things may differ because you have to know your age, your retirement plan, your risk tolerance. So that's why I always say, you can go to a financial advisor, you can come to me. I'm not a licensed investment advisor, but I've experience in the market. So I can give you some insights, some things for you to think about, right? So most people rush into the exciting part of just buying and skip the important part of education. So in closing, make sure you subscribe and stop thinking small and being a reactive player in this market. Start thinking like an institution, like what hedge funds do. Be patient, want cash, do research, and wait for uncertainty. If you want help building a clear, disciplined investment framework, I offer limited coaching on www.streetwiseeconomics.com. And if this video resonated with you, hit a subscribe and a like. I'll see you in the next video. Bye bye for now.